Hi, and welcome to October's video series of Thursday Talks. So, last month we spoke a lot about the particular factor, the low volatility factor. And this month I thought, let's go back to first principles and understand what exactly is quant investing. I've got a lot of questions and comments, uh, very nice comments and queries from a number of people. I'm going to try and address some of them as we go along. But at the same time, I believe there is a lot of misconception as well as not a lack of. I would it is a slightly opaque field in that sense, an upcoming field. It's cutting edge. So uh, obviously, there would be very little information. We don't have a TV channel devoted to quant investing, so like you do to other forms of investing. So obviously, so we're going to try and talk more about what exactly it is, how it has emerged, how is it. Because see, ultimately, investing is about having a process. It's about making money. It's as simple as that. It's like saying I'm going to the gym to be healthy or make a body. Obviously, everybody is going to do that. So everybody is into investing to make money. Obviously, but there are different ways. There are different ways to skin a cat. So let's get into what is quant investing, and let's jump right into it. So, what are markets? Markets are basically, uh, an auction mechanism where, uh, based on the wisdom of crowds, prices get set. These crowds keep changing their collective view based on new information as it comes in, uh, which creates volatility because in times of high certainty there will be volatility. So it feels like something random is going on. It's not something random all the time. Sometimes there is also random, but not most of the time. Now there is a feedback loop because it's not just one of the inputs into this new information is also new prices, and it becomes a kind of a circular or a feedback loop where prices are feeding into uh, a person's reaction and a person is reacting to prices. So, it becomes a circular motion, what George Soros calls reflexive loop. And, we are ourselves part of the market. So we cannot be independent observers as we can be in a science experiment. You can see an apple falling from a tree and you can be the observer, but as a market participant, you are also part of that process. So at any point in time, all investors will never have, complete, unbiased, objective views and information. So that's one of the fascinations and that's one of the features of market. They usually correct over the long run. We feel that, oh, why has the market corrected like this? On the day of the Federal Reserve meeting, it went down, and the next day it was up again 1,000 points. On the day of the RBI meeting, it went down, and again within 2 hours it was up. And on the day of the budget, it went down, and a company announcement came, and something else happened. The market is trying to process all of this, and it takes time. And long-term trends do not form in an hour or a day or a week. They take months and years. So if you are even a quantitative investor, you will and or if you are looking at trends, long-term trends as an investor in fundamental information, you will look at very long-term data. It's not day-to-day or hour-to-hour kind of stuff. Now, investing again, in like any form of execution or process-driven endeavor, it can be empirical, it can be theoretical. Like empirical is something which is data-driven, which is observed, which let me give you an example. Let's take the example of momentum stock. Now, we look at, we have a way of looking at momentum. We know that in a medium term look back period of say 3 to 12 months, if you look at stocks that have done well in the last 3 to 12 months, there is a high probability that over the next 3 to 6 months, these stocks will do well, or will do better. A portfolio of these stocks will do better than the rest of the market, or they will do at least better than the stocks that have not performed too well over the last 3 to 12 months. So here we are observing the data, we are forming some kind of assumptions about it. We are seeing that there is some sort of correlation between these stocks, which are doing well over the last 3 to 12 months. And then we may not look at causation. We of course, if something of this sort, we are able to understand the reasons why this is happening. That's good, because that gives you more confidence. But is it really necessary to make money? Jim Simons thinks not. As long as it's robust and statistically proven, and you can make money of it, why would you get too much into the whys of it? But as human beings, we do have that natural inquiry into things, why they work, what they work. We are pattern seeking animals. We want to understand why something is happening. This is one of the reasons why quant based investing is also very, very hard for people to follow. It's not just about pressing a button and just making money. Theoretical, on the other hand, is driven by a hypothesis or a theory that you may think that, okay, value stocks, which are cheap stocks, or stocks that are cheaper than the rest of the market, will do well, because the bad news that is caused them to sort of go down, or cause them to for them to become undervalued, is an aberration, and that will mean revert over the next couple of years. And so we are moving from a theory. So we are identifying the cause, we are identifying the hypothesis, and then we look at correlation. So but they're both moving. If you see, they're both moving towards the same thing, but from different angles, and which is why sometimes both these camps get into these saying that my way is better than yours, or things like that. I have been on both sides. I've spent a decade as a private equity investor and a fundamental driven investor. I've spent almost a decade now building systems, investing, trading, and I believe both approaches work. It depends on what works for you. So uh, I think people should just respect each other's process and move on from there. But doesn't seem to happen all the time. Now, what do most people think, when they hear about quantitative investing? First thing that comes to mind is they think of it's high frequency trading. It's not all. It's high frequency trading is one part of quantitative investing. It is not everything that is there in quantitative investing. They think it is high churn all the time. It's not necessary that it should be high churn all the time. They think it's automated computer-driven algorithms if it's quantitative investing. No, it's not automated all the time. Algorithms are anything. They were used in even the 1940s. Algorithm is just an English word for a step of coded processes. Even Alan Turing used algorithms to break the codes during World War II. So they are not. They think that if the factors driving my model or process, say, is momentum, then and some other investor also uses momentum, it's the same thing just because it is quantitative. No, it's not. There are many ways to many assumptions that go into, just like a car built by say two companies will have four wheels, will have an engine, will have a steering wheel, will have a dashboard. Yeah, so some characteristics will be the same. Attributes will be the same, but not necessarily they will be exactly the same in terms of the look back period, the way we construct a portfolio, the way we define our entries and exits, the way we manage risk. There are different ways to do the whole thing. So not all. So a smart beta index, which is completely codified, transparent, and laid down, uh, does not mean. And if I'm running a PMS, which also uses a momentum-based approach or a low volatility-based approach, it's not going to be the same. There will be some additional features that are built into my investing process, which are different from the smart beta index. And not to say one is better than the other, but it's important what works for you, what fits into what is more important for you to achieve your goals, and which one are you more comfortable going along with. So, that's where I will leave it today. And we'll go into a lot of these things in more detail over the next, at least over this month. Send me some questions, send me some another, uh, queries that you may have on quant investing or any other points that you may want to understand about quantitative investing, and I'll be happy to address them in the weeks going forward. Uh, this is a disclaimer that there's nothing, it's not investment advice, and we just for educational purposes. And please consult your investment advisor before investing. Thank you, and wishing you all a very happy belated Dussehra. Or you can follow me on Twitter at Anish Daily. You can at QED Capital, at QED Cap. You can visit us on QED Cap. There are some research papers that we put up there. You just go to the Invest with Us tab, and under that you go to Research Papers. You will get you'll see those research papers there. And like, subscribe, and follow our YouTube channel, and please comment on whether you like the videos, whether you would like us to do something different, or so yeah, we'd love to hear back from you, and see you again next week.